shorting is where you're expecting the price of the stock or commodity or whatever it is you wanting to drop. In other words, it's going to get less and less and less.
Okay.
So you're going to say, I'm going to sell this thing off and I will buy it back when it's reached a floor price of some sort.
Brilliant. Craig?
Yeah, I would agree with that. Yeah, you would buy the stock hoping that, sell the stock hoping that it'll go short, it'll go down, and then you'll buy it back when it drops, and then you'll make your profit because you sold it and you're buying back at a lower price.
Shorting is where you sell or go short an underlying market at a high price. You expect the price to drop, and then you'll buy it back at a low price for a profit. Okay? So traditionally with trading long, you buy low and you sell high, and when you trade short, you sell high and buy low. But now the question that I asked you is, Sam, you have a question?
Timon, my understanding of selling short, and I've done this many times, is you actually sell shares that you don't have.
Correct.
And then, so you don't own the shares, you then hope that the share price will drop, you then buy them at the lower price.
Yes.
But you've gained the higher price.
Yes.
The risk which has happened to me a few times is that I speculated the share price would drop. It didn't, which means I had to buy at the higher price and I lost money. So for me, this is quite a risky thing.
100%.
But if you're using certain tactics, certain trading strategies, you could probably get it right 60 or 70% of the time.
Yes, and that's why in this event I want to go through ways to make it less risky, why shorting is more risky in general, and to understand what that means to sell shares that you don't actually own, because that seems a little bit of a foreign topic to the traditional investing. So here is the next slide, which is the term of the day, which is shorting. And I want to explain just these steps in general. So the first thing is you sell a number of shares which you don't own at a higher price. Okay? But now, how can you own shares that you don't have? Basically, you borrow the shares from a broker or a lender, for example, a market maker. So, okay. So in this case, the seller sells or goes short 200 shares, that is 10 Rand per share, worth 2,000 Rand. Notice the company is COVID limited because we expect the company to crash soon. So the seller sells and goes short 200 shares. After time, the share price drops to 7 Rand. So it's gone from 10 Rand to 7 Rand. You then decide to buy back 200 shares for 1,400 Rand. Okay? So far you've sold them for 2,000 Rand and you bought them back for 1,400. Basically, then, as soon as you buy back those 200 shares, you automatically return the borrowed shares to the broker and you pay them a fee. And you will then pocket the difference. Okay? So the broker gets the shares back, you get the profit, bada bing, bada boom, done. That is how shorting works. Now, my next question for today, because I do like to choose one topic going forward, and then we'll go through. And then if you do have a general trading question, I'm happy to answer at the end, even if we go through, go past some time, as this is a free event and a relaxed event. So the next question we have is, why is it called a short?
Short because you're selling your you're selling the stock, so you're going you're going short.
Okay, I'm going to have a stab at it. I don't actually really know. I've never thought about it, but I would assume it's called a short because of the fact that we are expecting it to go less and not expecting the price to drop. Whereas in the case where we're expecting the price to go higher, then we're taking a long position.
Okay, very good. Sam, any ideas?
Timon, the only thing I can think of is that it's just purely a short speculation.
Nice, that's a good one.
A very short speculation on what the share is going to do, and that's why it's called short.
That is very
But
good.
I don't know the origin.
So yeah, I've got this little piece of paper that I've printed, and I'm just going to read this quickly. The term sell short and short position seems to have arisen in the US stock and commodity markets about 1850. The earliest use I have found is from the Merchant Magazine and Commercial. Now I love what it says here. Selling short is selling before buying or selling what one has not. Where the origin of the short comes from, the first speculation is that normally a bear market or a falling market is very aggressive compared to a bull market. We say that the market moves down a shorter time than when it goes up. So what you'll notice with the premium multi-trader service this year alone, I have not taken one short trade idea and I've only gone long. And when the markets move up, they move up 70% of the time and they drop 30% of the time. So that's what we're saying is when you go short, you expect it for a short period of time that the market will go down. The second thing is that they say that the price goes down a shorter value than it can potentially go up. So this is true because generally when you buy a stock or a market, it can only drop to zero, right? So it's a short distance that it can drop. But when the market goes up, it can go up thousands of percents, 10,000s of percents. So those are the ideas of why it is called a short. Now my next question is, why is short selling risky?
You're busy selling something that you don't have, and the market could potentially turn against you.
I don't know. I wouldn't know whether it's any more risky than going long.
You see, these are the discussions that we should be having. That you can find it on Google, but you might not have those type of questions. As an investment with AltSpace VR, I would highly recommend you get yourselves a headset with a nice microphone and speakers, not speakers, headphones. Because it's better to hear every single word that everyone says, and this is how we're going to learn from trading and mistakes and experience this. And also, I'm predicting that this is going to be the future of live events in the next 2 years. So I've got myself something called an Omen Mind Frame. It's a HP headset, and it's absolutely incredible. I mean, it even has this cooling effect that cools the ears, so you can attend other events in this platform. Live events, improv nights, whatever you want.
I think probably the biggest reason is the potential for unlimited losses, number one. And from my experience is that you normally short a company you think is a bad company, and there are a number of events that could suddenly reverse the fortunes of that company, and suddenly you find yourself in a bull market for that particular share. So those are the two that I've experienced.
As a rebuttal, as an investor, Sam, I would agree 100% that you should short companies that will drop 40, 50, 60%. So you take a similar investing approach. As traders, we do not look at bad companies ever to short. We never look at bad companies, because if we were to short bad companies, there would be liquidity problems. There would be possibilities of liquidations. Okay? We choose high liquid, very good companies that have run up, and they have run up too far and they are about to come down now for a short amount of time, for example 3% or 6%, which we as traders take advantage of. We short, we buy high, and we sell high and we buy low for hopefully a profit. And sometimes we short when markets continue going down. Rather than shorting at the top, we like to short also at the bottom where markets are moving down on a trend that's continuous. Also notice that brokers, a lot of brokers do not offer shorting opportunities for bad companies. And what I mean by bad companies, I mean medium cap to low cap penny stock companies, because the risk is too high that many traders or investors will manipulate the share, which will crash the share price down. Okay, so that's another reason why we never look at shorting bad companies. In fact, you'll notice that there are more companies to buy and go long than short on the stock market and the AltX. All right, so now my thoughts on why short selling is risky, because this is a discussion, is that exactly as Sam said, there is no limit to the amount of money you can lose. A share price, when you buy, can only go down to zero. But a share price can go as high up, and when you are short, you can lose more than what you put in, and you can lose a lot more. And that is why high-geared instruments such as Forex, commodities, and dare I say indices on a lot of other brokers is very risky. When you see a gearing of 100, 200, 300, run for the hills. And I know I'm going to probably get into arguments and debates because most people are searching for high gearing. But when you've been in the game as long as me, what you want to do is you want to be as risk averse, and you want to sustain your position as a trader. The second thing is that when you buy for example, CFDs based on the underlying share you buy, you will receive the value of the dividends for when they come out. And when you go short, unfortunately, you have to pay the dividends when they come out. You pay the value of the dividends when you short the company's CFDs. And third is that it's risky that sometimes shares aren't available to short due to, which depends on your broker. So it's always better to, if you want to be a top shorter, it's always better to have two different trading accounts. Probably not if you've just started trading, but when you've traded for a couple of years, you'll say, you know, I also want to short these companies that my trading account doesn't offer. So that concludes the discussion for today. What I do want to ask is, does anyone have questions on short selling topic for today? Craig, when you're done, you've got to go to the menu and change that avatar and show us how you look in general, you know. It gives a bit more persona. I think same with you, John. I'm happy to help with that.
Okay.
So to go to the main menu, you click on the escape button. Okay? And then you go to me. And then you go to customize avatar. You don't need to do that now, but I'm just showing you how to do it in the future, all right? Now, in the future,
Okay.
I do not plan to run the events per se in this location and in this world. I'm going to be creating a trading world inside a virtual reality world, and I'm going to show you right now where it will be based. It's probably going to be nice and modern. It's going to have more screens. It's going to have more interactable objects and polls and questions. So